This morning I wanted to take some time to go into how you can look to see what the banks are actually losing on what people are classifying as risky investments. What you have heard is that SVB Bank made some risky investments, and because of those investments, the bank went under, and people almost lost money if they had over $250,000 in their account, but the FDIC stepped in and insured them. So let's get into what those losses kind of look like and how you can tell what is going on before they come out with the quarterly financial statements from those banks. So let's get right into this. What you guys probably are aware of is this graph right here. Now, what this is the Fed rate increasing over time, and you've probably seen a YouTube video or heard some news, and people are talking about the Fed keeps increasing rates. Now, this increase in rates, they'll say, doesn't cost banks money. In effect, it is the underlying pusher of the overall losses in the banking sector. Kind of like when gas prices go up, the price of food and other things goes up because that is a component of those prices. So here's how you can basically look at the $600 billion number that banks haven't lost yet, have in their balance sheets as of December 31st. And see, has that got worse today? Has it got better today? Or how much is that underlying loss that the banks are incurring? So if you pop onto here, there's two assets that, for instance, SVB Bank bought and carried on their balance sheet to back any deposits that depositors had. The government said these assets were safe and you could claim them to be zero risk on your balance sheet. So one asset that they bought was mortgage-backed securities. Now, mortgage-backed securities pay an interest rate, and if your interest rate when you bought them was 3%, and your interest rate goes up to 6 to 7%, you lost between 3 and 9% of the value of those mortgages if you have to sell them. Okay, so the first component you have to understand is the underlying asset, or what you bought, lost the value. Now, if that value loss was in what was considered a risky asset, such as a stock or other things, you would have to take those losses on your balance sheet, and so you would see a hit in the profits on the SVB Bank. But in this case, the government allows them to have mortgage-backed securities and government bonds at a zero risk asset, and just note on their balance sheet that they're going to carry these all the way to full payment of the asset. And so if you look here and we pop into here on December 31st, you've got a 6.42% interest rate, which is what they would have used to calculate the losses that they're going to carry on their balance sheet on these hold to maturity assets. Now, most of the time they don't talk about this being the source of that loss. And the reason they don't is because this 30-year mortgage is generally determined a lot by the 10-year treasury rate. So this is the rate that if you buy a 10-year government bond, how much you're getting paid on it. So if you'll notice over time, this thing is jumping around, and it kind of runs in a similar pattern to this 30-year mortgage. So this is really based on this 10-year treasury. So if you want to understand how their losses are happening, you basically can look up online and say 10-year treasury rate over time, and right here is January or December. So that $600 billion loss would have been calculated using a treasury rate of 3.88%. So if the treasury rate is down below that, or like here it's kind of stabilized, not higher or lower, then they aren't losing more money at this point. Okay, but if you see this go up higher, like to 5%, 6%, then they're losing that additional amount, which is I figure between 1 and 3% per percent change in the underlying treasury rate. And so they acquired some of those bonds on, it said about 1.9%. So it said they owned treasuries and mortgage-backed securities paying 1.9%. Then they sold those to another bank and had to take the $2 billion in losses on their balance sheet when they actualized that sale. Okay, so that's what it's based on. So the situation now has changed somewhat. FDIC stepped in and said we will cover all depositors. Most of the depositors in SV Bank were not insured because they had more than $250,000 in their account. It was over 90% did not have full insurance. The largest depositor, from what I have researched, was Circle, and Circle is the backer of USDC stablecoin, and they had $3 billion, and another one that was in there was Roku, which had $500 million. So the government stepped in, FDIC stepped in and said, hey, we're going to cover those assets. The second thing they did was they went to the banks and they created a facility where if there's a run on a bank, and let's say a bank has $20 billion, so the SVB Bank, let's say, has $20 billion in treasuries. Instead of having to sell those treasuries to get liquidation, the government came in and said, we will give you up to the $20 billion on those hold maturity securities, so you don't have to actualize that loss. And so essentially what is happening is these zero risk assets that are backing the banks are being allowed to continue to defer those losses on their balance sheet. The first mechanism of deferring the losses was just the footnote which says we didn't actually incur this loss, we're going to hold this security till the end. Okay. The second mechanism now is, even if we need this money, the government's going to lend us this money until the end, and that's going to allow us to further defer that loss on the balance sheet. So they're just pushing it down the road. Now, the reason this I don't think is systemic or like a domino effect is because the problems all come from one source. It's coming from the Fed raising rates. The Fed raises rates, which changes the market's expectation of what rates will be in 10 years. Right now, as you remember that graph, and I'll show it to you again, you've got a 10-year treasury at 3.95%, which means the market is expecting that to be a reasonable amount to be paid to put money in an account, in a place, and not access it for 10 years. Now, the current inflation rate is, let's say, 7%, and the Fed interest rate is 4%. So what they're expecting is that this has a peak on the Fed rate of, let's say, 5.25% or something, and then it starts coming back down. How do you know they're expecting that? Well, if they weren't expecting that, this rate would be higher, because you would have a longer term commitment of your money being paid more interest than a shorter term. Right now, the shorter term is paying more than the longer term. So if you look at the 6-month treasury, it might have been paying 5% a few days ago. And so they're expecting to come back down. Well, the real risk here is what happens when the market determines that the rate's not coming back down. Now, I know they said, this was a short-term thing, okay? But let's go back through the history, okay? The first thing they said was inflation is transitory, okay? 9 months later, they said inflation is not transitory. We're trying to get it out of being systemic, okay? So if the first thing they said was not the truth, they either lied or they're not competent, okay? Either one, you can't really trust what they're saying. So right now they say there's inflation, but we're going to fix it, okay? So what if the inflation is ingrained. Okay? It's transitory. Oh no, it's not. That's not inflation. Now it's regular inflation. What if the inflation is already ingrained? Well, ingrained inflation takes a longer period of time to get fixed. Okay, the interest rate may have to go up, like it did in Volcker days. What if the interest rate goes to, let's say, 12%, and the market determines that the 10-year Treasury can't be priced less than 9%? Well, now you got not the difference between 1.9 and this 3.5, which is 1.2%. So you have a loss on the bank's books of, let's say, 2 to 6% on those assets. But now you have 6% more, and maybe you have a loss on the books of a couple $1 trillion. Well, a couple $1 trillion makes exactly how many banks at a negative capitalization? When the market goes and sees, let's say, Credit Suisse, which is a Swiss bank, at a negative capitalization, or they see, regional local banks start to be at a negative capitalization, or they start to see, let's just say, a larger bank like J.P. Morgan at a negative capitalization because, let's say, their bond losses go from $48 billion to $200 billion, and the company's only worth $250 billion. Who's going to bail them out? Well, it's real easy to determine who's going to bail them out. Okay, who has $250 billion? That's your list. Okay, so the government's going to bail them out. Why? It's the only person with access to that amount of money. And so what the Fed has to try to do in this situation is to, if you go back on this graph, is to raise rates fast enough that they get inflation out of the system before this 10-year Treasury completely reacts to a regular yield curve. Okay, so if they go up here, and what I'm expecting is this rate, maybe another 2%. Okay, so they said inflation was 7, and they have already said that they need to raise the rate to higher than inflation to get inflation under control. So inflation is 7 right now. So they raised the rate. Inflation was 9. So they're trying to get this rate to be slightly higher or similar to inflation. So if inflation comes down to 5.5, then maybe their terminal rate's 5.5, and that's what the market's expecting now. If inflation goes back up to 9, then their terminal rate may be 9. And so here's what you can do. Watch the inflation numbers coming out. Understand that the inflation number coming out is most likely the terminal rate of this Fed rate. Okay? So inflation number is 7 now. The target rate is actually 7. It doesn't matter what they tell you, because they told you it was transitory, and then they told you you're going to raise rates a little bit, and we told you the banks are fine, right? So stop listening to what they're saying and look at the data for yourself. So you've got this rate at 4.5. You've got an inflation rate of 7, and that's on their calculation. We can go more into what inflation calculations actually are later, but 4 to 7, that is your gap that they have to close. They can close that by bringing inflation down. They can close that by raising interest rates. But they have to close that gap. Right now, that gap is 2.5%. Additionally, as far as bank losses, you have to understand that the short-term rate is inverted, meaning the short-term rate is 5%, but your 10-year Treasury is 3-something%. So the market is expecting these rates to come back down so that the short-term rate is under 3.5%. That's the expectation today. So we'll say like a 2%. Okay? So the market is expecting that the average rate of return over the next 10 years is more like 2%. Now, if we get to 5, we get to 7, and the Fed says, hey, it's going to hold at this level for 2 years, the market's no longer going to expect the average rate over 10 years is going to be 2%. They may expect it to be 5%. Okay? So if they expect that average rate to be 5%, then this rate has to go up dramatically. Okay? And if it goes up, let's say it doubles down again, it goes up another 2%, then you've got another $600 billion in losses on the bank's balance sheets. So just take all the banks across the board and take how much they're worth today, take on their 10K their loss, which says I've lost 48 billion, but it's unrealized, double that and see what the bank is worth. It's as simple as those as I understand it. Now, the Fed understands this. This is not an accident, but if you take it from a logical standpoint, either they are doing this on purpose or due to incompetence. It's your decision. Look at their history and what they've done, and that'll help you decide what the situation actually is and what their intent is in the situation. Hope this helps you understand what's going on, the cause of it, the effects, and what you can look at in the future to see how much worse it's going to get. I'll try to make a video later and think through what I'm doing and some ways that I'm taking this situation and trying to make money in it, because I believe wholeheartedly that we as individuals, if we act with wisdom, we can make money and we can increase our value in any situation. And so thanks, and like and subscribe down below, and have a great day.